Okay, let's talk about some of my most overlooked tax write-offs for individuals or everyone in 2022. Because after preparing tax returns for clients for many years, I've usually been able to find 1 to 2 qualified expenses that my clients had no idea they could write off. And that's actually very common because in fact, every year more than 2 million taxpayers overpay their income taxes. And this means you could literally be leaving free money on the table that you're actually entitled to simply because you're not fully leveraging the tax system. But if you take advantage of the tax write-offs for individual taxpayers from this video, then it will surely help you to reduce your taxable income, thus in turn helping you reduce your tax burden. So in this video, I will cover exactly how the tax system works. We'll take a deep dive and a deep look at the standard deduction for 2022, and I'll reveal my most overlooked tax write-offs for individuals. And after you finish this video, I want to hear from you, okay? Tell me in the comment section below if you learned about any new tax deductions that you didn't know about before. Stay tuned. Hey there, I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. And if you don't mind lending a helping hand, please hit the like button below to help this video reach more people like yourself. All right, let's go ahead and dive in with the first part of this video. Number 1, how the US tax system works. Now to explain this very easily, we're gonna use a fictional character throughout this video, which we're going to name James. And James is a fictional corporate executive that earns $100,000 a year and is currently single. So James' goal is to make smart investments, leverage the tax system so that he can eventually retire comfortably. Okay, so let's take a look at James' tax situation. We're gonna put up on the screen the planned federal tax brackets for single filers in 2022. Now, can you guess which tax bracket James falls into? If you said none of the above, then you're correct. You see, even though James' $100,000 salary fits into the 24% tax bracket, that is not his effective tax rate, and he won't pay $24,000 in federal taxes because being in a tax bracket doesn't mean that you will pay the federal income tax rate on everything you make, because the United States has a progressive tax system, which means that people with higher taxable incomes are subject to higher rates and people with lower taxable incomes are subject to lower federal tax rates. This is what makes the tax system fair. So before the standard deduction, James' federal taxes would look more like this. His total taxes paid would be $17,781, which means his actual effective tax rate will be 17.78%. And you can pause the video here if you really want to take some time to understand the math. And these calculations are before any tax write-offs or any tax deductions, which brings me to number 2, the standard deduction. So here's the thing. Every individual is entitled to what is called a standard deduction, which is a specific amount that the IRS issues every year that is given to taxpayers. It's a given deduction, and the amount that you receive depends on your filing status, whether you're single, married, etc. So for example, if we go back to James, remember, he was a single filer, which means that his standard deduction would be $12,950 for 2022. Thus reducing his taxable income from $100,000 to $87,050, which in turn would lower his effective tax rate in the amount that he pays to the IRS. However, if James got married later this year, he could get a standard deduction up to $25,900 for 2022, which could lower his effective tax rate even more. But remember, his spouse actually may increase his taxable income as well with her own income and wages, so it could end up being a wash or a different situation altogether. And by the way, if you are newly engaged or married, then make sure you check out my video on how marriage affects your taxes right after you finish this video, which I will link to in the description below. Okay, I'll go ahead and put on the screen right now the standard deduction amounts for the 2022 and 2021 tax year. Okay, now listen, this is very important. You can choose to take the standard deduction or use Schedule A of the 1040 form to itemize your deductions. In general, you would only want to itemize your deductions if the amount of the individual deductions exceed the standard deduction amount that you're given. Okay, now that you understand that, let's move into my top tax write-offs for individuals, starting with number 1, charitable donations and donor advisor funds. Okay, now most people know that when you itemize, you can deduct any cash or non-cash contributions you make to a qualified nonprofit organization. A cash contribution would be stuff like the money you give to your church or helping someone raise money for charity on something like GoFundMe.com. Although it is important to note that donations made to a personal GoFundMe benefit are considered to be gifts and are not likely to be taxable. On the other hand, non-cash contributions would be stuff like donating your used clothes or donating your old furniture or donating equipment like your laptops or your old cameras, or even donating paper assets like stocks or crypto, or hard assets like your land and vehicles. Now, the IRS requires that you provide a qualified appraisal of the item or group of items when you make a non-cash contribution worth more than $5,000. And for contributions below that amount, you just need to make sure that you can substantiate the donation with something like a receipt or a third-party assessment. To explain this deduction further, let's look at an example using James. Okay, so remember, James' taxable income after the standard deduction was $87,050, which brings his estimated tax to $14,774, which is an effective tax rate of 16.97%. But to lower his taxable income, he's going to donate $20,000 with a mixture of different cash and non-cash donations. Well, in this scenario, James' taxable income will go from $87,050 to $80,000. And remember, that's because he's no longer getting the $12,950 standard deduction for single filers. So when James makes this donation, it brings his tax burden down for a total tax savings of $1,551. Now, as a side note, the CARES Act allows individuals who do not itemize, thus they're taking the standard deduction, to deduct up to $300 in qualified contributions as well. Okay, now here's an individual tax strategy using donations that many people don't take advantage of, which is called a donor advisor fund, or DAF. So in most cases, when you donate to charity, the transaction and the tax deduction occurs instantly. But a donor advisor fund, or DAF, is like a charitable investment account for the sole purpose of supporting charitable organizations that you care about. So when you contribute cash to a DAF, then those contributions are eligible for an immediate tax deduction, and those funds can be invested for tax-free growth. Then at any point in time, you can donate funds to IRS qualified public nonprofit organizations. So the flow kind of looks like this, okay? You contribute to a charitable fund, then you get an immediate tax deduction that you can take right now, and then those funds can grow if you decide to invest it in something like the stock market, and then you can donate to the organization that you choose. So with this, you don't have the pressure of deciding, okay, what charity you want to donate to right now, and your donation can be much larger as your investment appreciates. Now, if you're interested in doing something like this, you can set up a DFA with a fund like Fidelity to pursue this strategy. All right, moving along to individual tax write-off number 2, vehicle sale and property taxes. Now, of course, you pay sales tax on a car when you buy it. And some states like Georgia continue to make you pay ad valorem taxes on your car each year. Now, thankfully, you can deduct these types of sale tax payments on Schedule A as an itemized deduction. And in general, you can choose between 2 state tax methods, which is either number 1, taking a deduction for sales taxes, or number 2, taking a deduction for your state and local income taxes. Now, of course, you want to pick the method that gives you the highest tax deduction. And these taxes also apply to assets like RVs or boats. So make sure you check your registration paperwork to see if you're paying any property taxes on those too. Now, you need to know there is a limit of $10,000 for state and local tax deductions, which includes all property, sales, state, and local taxes. Now, if you own a business, you can take even more vehicle tax deductions, and I have a video called How to Write Off Your Dream Car that breaks it all down, which I'll link in the description below, and you can watch after you finish this one. Okay, moving on to tax write-off number 3 for individuals, I have your home. So one great benefit of owning a home is that it can give you some major tax write-offs each year, including points paid to buy down your interest rate on a new home loan. Now, one of the biggest home costs you can deduct will be your mortgage interest payments. Here's how it works. So you can deduct mortgage interest payments on the first $1 million of mortgage debt you have if you bought your house before December 15th, 2017. Or you can deduct mortgage interest payments on the first $750,000 if you bought a house after December 15, 2017. For example, if you got a $900,000 mortgage loan to buy a house in 2017 and you paid $30,000 in interest in 2022, then you will likely be able to write off the total $30,000 in interest. On the other hand, if you got a $900,000 mortgage loan to buy a house in 2021 and you paid $30,000 in interest, then you will likely have a smaller tax deduction. Now, in addition to mortgage interest, you can also deduct other home expenses such as interest on a home equity loan, state property taxes, mortgage interest or PMI, and prepayment penalties. Now, while we're on the subject, it's also important to note the home expenses that you cannot deduct as an individual, which would be stuff like homeowner insurance, principal payments, title insurance, settlement costs, deposits, down payments, or earnest money. And if you own a home, then you can keep the tax deductions or tax credits rolling with number 4, the residential energy tax credit. Now, of course, the main benefit of solar energy is to reduce your utility bill along with playing your part in helping the world produce clean energy. So with this, you get a federal tax credit up to 26% of the installation cost for solar energy systems, including solar water heaters and solar panels. Now, this is a limited opportunity as the tax credit dwindles down to 22% for 2023 and expires in 2024. Also, this is a tax credit that is non-refundable, meaning that you can't get savings in the form of a tax refund. Okay, let's keep going with tax write-off number 5, education and educator expenses. So if you take out a loan for qualified education expenses, then you can deduct the student loan interest. Qualified education expenses will be things such as tuition, room and board, books, and other necessary expenses such as transportation. This also applies if you took out a loan for a dependent or you were obligated to repay the loan for any other reason. In addition to the education expenses, let's talk about the educator expense deduction, which allows teachers or eligible educators to deduct $250 spent on classroom supplies. Okay, up next, I have number 6, invest into a 401k or IRA plan. Many companies offer some kind of employer-sponsored retirement plan like a 401k, but if they don't, that's okay because you can set up your own IRA plan as well. Now, if you don't know about this yet, just understand that these are simple retirement accounts that allow you to take your pre-tax income and invest it into things such as stocks or real estate. Now, 401ks and IRAs are very similar except for the fact that 401k plans are typically provided by a company who also contributes to your retirement account, while an IRA is simply an account that you set up on your own. Now, here's how these accounts can help you avoid taxes. Every dollar you invest into a traditional 401k or an IRA can be deducted from your income. And remember, your tax is based on your income. So by taking this deduction, you are lowering your income and you are paying less taxes or receiving more money back on your tax refund. Not only that, but you may also be able to lower your income to a point where you're in a lower tax bracket, which gives you even more tax savings. Now, the IRS does have a limit on the amount that you are allowed to contribute to these accounts. For example, if you are investing into a traditional IRA or 401k, the contribution limit for 2022 is $6,000 per year or $7,000 if you are above the age of 50. So if you don't mind setting aside some money later for retirement to help you save on taxes, then definitely consider setting up some type of retirement account. All right, tax write-off number 7 are medical expenses. You may be able to deduct qualified medical expenses that are more than 7.5% of your adjusted gross income, or AGI. For example, if your adjusted gross income is $50,000, anything beyond $3,750 could be deductible. So if you had $10,000 in qualified medical expenses, you could deduct $6,250. The types of medical expenses that are deductible are payments to doctors, dentists, surgeons, chiropractors, psychologists, and other medical practitioners. You can also deduct hospital and nursing care costs. You can deduct weight loss programs for doctor-diagnosed diseases. You can deduct prescription drugs, as well as insurance premiums for medical care or long-term care insurance, and a lot more. Okay, you can see a complete list by looking for IRS publication 502. Now, the awesome thing here is that you can combine medical expenses with our next tax deduction, which is number 8, the health savings account. Also known as the HSA, a health savings account is literally what it sounds like. It is a savings account for your future health-related expenses. Health savings accounts are tax exempt accounts that you can use to pay for the medical expenses that we talked about. So think about stuff like prescriptions, deductibles, etc. Amazon even has an entire catalog of different products and services you can buy using a HSA. And at some point, listen, you're going to need to pay for something medically related. And why not use your money tax-free? Because the money you contribute to an HSA is tax deductible, meaning that the money you put into the account will actually lower your taxable income, which ultimately lowers the amount of taxes you pay at the end of the year. The contribution limits for 2022 are $3,650 for individuals with high deductible health coverage, or $7,300 for families with high deductible health insurance coverage. Okay, now these are some of the most overlooked tax deductions for many people, but I've also got to mention briefly another tax credit, which is number 9, child tax credits and dependent care tax credits. Now, I'd be surprised if you haven't heard about this by now, but you can actually get a tax credit up to $3,600 per child for the 2021 tax year. In addition, parents can get a child and dependent care tax credit for children that they are unable to care for themselves. All right, so there you have it. 9 huge tax write-offs for individuals. Now, you should know the biggest and best tax write-offs are usually reserved for investors or business owners. So coming up next, we have 2 more videos to talk about how to start a business or a side hustle. So make sure you check those out if you haven't already, and I'll see you over there.